Hi, George Sanders back with you, and we are talking about the bear market for junior resource stocks. In part one, we explained that this is a unique and unusual situation that veteran observers have never seen before. The scenario whereby the price of precious metals is advancing nicely, gold is at all-time highs, and the stocks are at multi-year lows and have no audience. So why would that be? It's counterintuitive, and let's examine some ideas that various observers have come up with to see if we can make sense of this. A few bugs here in the West Kootenays today, but let me continue. So the first thing I want to talk about are two very related things, and that is liquidity and alternate investments. I won't go into all the details, but on Friday, Tesla traded $17 billion worth of shares. NVIDIA traded $39 billion worth of shares. The entire TSX Venture Exchange combined with the CSE, the Canadian Securities Exchange, so the entire Canadian publicly traded venture capital market, of which resources are no longer the main but still the biggest component, traded a whopping $69 million. So one stock, one big cap technology stock in the United States traded over 200 times more than the entire Canadian venture capital market, and another stock, NVIDIA, traded over 600 times more, one stock, than the entire market. So our business exploring for precious metals and base metals has always been a microcap business. No question about that. The difference is, in the last few years, that large cap, particularly technology stocks, began to have momentum. They began to have beta. That means they had a lot of trading action. When I was coming into the business in the late 80s and establishing my career through the 90s, a large cap stock might advance, but it did so over several quarters or a year. It kind of ground higher and, churned out its dividends and made its investors happy, but it didn't have dramatic 4, 5, 8% moves in a day like the stocks do now. So for those investors who are looking for a little action, maybe getting on a trend that's going someplace, they can now buy those big cap stocks and get that same kind of beta that they used to get only from small caps or micro caps. Additionally, in the last 10 years, we really have the advent of exchange traded funds. So you can now involve yourself in the market in virtually any sector by purchasing an exchange traded fund. What that does for the investor is it sort of provides one-stop shopping. They get exposure to the entire sector. If it's big cap technology, there is some beta to it, there is some movement, and you don't have to worry about exposure to one story. Importantly, whether an investor is in a Tesla or a NVIDIA or an ETF, if the market goes against them, they can sell immediately. I'm not talking a couple $1,000s. I'm talking investors playing with $50,000, $100,000, $500,000, a couple of $1 million. It's very hard to sell a junior exploration stock whose drill hole has missed without driving the stock to pennies or half a pennies. It's just the liquidity's not there. Whereas in the big market, you might take a small loss, but you can get out of your position and if you've got a sizable position, you can move it. So liquidity and alternate investments have drawn some of the speculative capital away from its traditional home into some place where it's never really been active before, but has been and continues to be currently. Now, without giving a market prediction and without suggesting there has to be a market crash or anything like that, that trend will eventually come to an end, and that money will be looking for a new home. But for the time being, it is drawing capital away from junior exploration and development companies. Second issue, explaining where we are. The bugs are a little bit more acute on a cloudy day, is demographics. As you can see, here I am, CEO of a junior exploration company, and I'm clearly no longer 35 or 40 years old. I am part of a whole cohort of participants that came of age between 1975 and 1985, who now, approaching 2025, we're all seniors or even older. So our space has a reputation of being populated by old men, and to a large degree, that's true. Now, the upside of that is there's a lot of experience. There's a lot of, we've been down the roads before, we've seen several rodeos, and that's a good thing, but nevertheless, that is affecting people's interest in putting new money and new capital into the space. There are lots of young people in our business today, and I have to say it's very exciting because the talent level of the young geoscientists, of the young financiers and market participants, of the communications experts, of the marketing and promotional people, the talent and skill sets of these young people are phenomenal, way better than what our group had at a similar age. The difference is there aren't that many of them. Whereas when we were coming of age, it was like the whole business was populated by young men and women between the age of 35 and 45. So we do have that demographic challenge in the business, and I do think it is affecting some investor appetite. A third thing that I would suggest is a possibility for declining interest is credibility. You know, over the years, a lot of promises have been made, a lot of enthusiastic presentations have been presented to investors, and for the most part, expectations have not been lived up to and investors have been disappointed. And as the demographic of those typical resource investors advances and those folks get a little bit older, the needs for how they manage their money change, and if they've lost some money on some of their favorite companies, they're disinclined to put any new capital into the business, and so credibility has been an issue. So we're looking at liquidity, alternate investments, demographics, and credibility. So if you stay with us for part 3, we'll offer some ideas as to how we address some of those issues and how we get out of this bear market.